Banks get the money they lend out from multiple sources. One source is the RBA overnight market, influenced by the cash rate. They also raise funds from customer deposits and from overseas and domestic money markets. If the cost of these other sources doesn't fall in line with the cash rate, banks might not pass on the cash rate in full. A great example is deposit rates. Banks take deposits from customers and then pay interest on these. When the cash rate is very low, deposit rates were also really near zero in a lot of cases. Banks were reluctant to cut deposit rates below a certain level because they didn't want to drive savers away. So as the cash rate approached near zero, banks didn't always cut the full amount of the home loan interest rates because they needed to keep their overall funding costs in check. For example, in June 2019, the RBA cut the cash rate by 0.25%. Two of the big four banks, ANZ and Westpac, passed on only 0.15 and 0.2 of the rate cut to their mortgage customers, while the other two big banks, CBA and NAB, passed on the 0.25%. This partial pass-through made massive headlines at the time. It was an instance of banks prioritizing their margins under pressure for funding costs.